The other day, Bloomberg published a chart showing America's twin deficits, fiscal and trade, are hitting the highs of the 2008 crisis and are already much worse than the previous recession in 2001. First, what is a twin deficit? The twins are the budget deficit, government spending more than it taxes, and the current account deficit, which is exports, and it also measures if we're a net debtor to the rest of the world, so capital flows. If you're running twin deficits, it means your government is getting deeper into debt by sucking resources out of the private sector, while your country as a whole is also getting deeper in debt to foreign countries. In short, government takes from the people who borrow the difference from China. The numbers are fairly big at this point. The twin deficits combine to roughly 15% of GDP per year. That's almost $3.5 trillion, which is incidentally about 50% higher than it was in 2008 in dollar terms. Now, those twin deficits have long been a major flag in developing market analysis, identifying countries that are on an unsustainable fiscal path, living beyond their means, and inviting a crash. The problem is that beyond the compounding trillions in interest you have to pay, at some point foreigners have bought up so much of your land, your companies, your debt, that they are less enthusiastic about buying more. After all, there are a lot of assets in the world, and they only want so much of ours. This pushes up your interest rates. You have to pay more to tempt foreigners to keep lending to you, and it threatens the dollar, which is now the dirty shirt in the pile nobody wants. This is why twin deficits are such a red flag for developing countries. The crash hits rates and it hits the currency, both of which crash the economy. Of course, the U.S. can keep this game going much longer than some random Malaysia, since the dollar's reserve status creates a large appetite for foreigners to buy up U.S. assets. Large, but not unlimited. And this is why so much is riding on the dollar. I've done a number of recent videos on de-dollarization, why it could turn one of America's biggest strengths into a catastrophe for the American people. And in short, the reason is there are something like 2 to 3 times more dollars in existence than America needs. By the way, nobody actually knows. And those extra dollars are held by foreigners, meaning that if the twin deficits drive foreigners to lose their lust for dollar-denominated assets, or, by the way, if some other event like sanctions or a gold-backed BRICS accelerates the flight out of the dollar, then potentially tens of trillions of dollars come flooding home. After all, Americans are the only people in the world who are obligated to actually use the dollar. At that point, we go to the developing country record. Massive spike in interest rates, double digits were common in the 1997 Asian crisis, while the flood of dollars would crash its buying power. In the 1997 crisis, currencies dropped by between half and 4/5. In short, becoming a reserve currency is like climbing a cliff face with no rope. Only the alpha countries even try it, but once you are a reserve currency, you better not let go. At this point, America is swimming in debt. Indeed, we become reliant on that debt. It is cracking, and each time they patch it with yet more trillions of debt. They are kicking the can, but each kick makes it heavier and heavier. At some point, they will kick it, and it will not budge. Okay, we'll be watching. See you next time.